Gold and silver were hit hard today. Prices fell fast, and the move caught many investors off guard. At the same time, several indicators tied to U.S. banking stability began flashing warning signs. Regional bank shares weakened. Funding costs ticked higher. Credit spreads widened quietly in the background. On the surface, these two developments do not fit together. Traditionally, when confidence in banks starts to wobble, precious metals respond in the opposite direction. Gold, especially, has long been treated as a hedge against financial instability. When trust falls, gold often rises. That pattern has repeated across decades of market stress. Silver, though more volatile, tends to follow the same emotional current. So when gold and silver drop sharply on a day when banking stress is building, it creates tension. Something is not aligning with the script investors expect. Either the stress signals are being misread, or the metals market is reacting to a different force altogether. This is where most analysis stops. Commentators will say it was profit-taking, or a strong dollar, or rising bond yields. Each explanation may contain a piece of truth, but none of them address the deeper issue. Why would assets designed to protect against instability fall at the very moment instability appears to be growing? To understand that contradiction, we need to step back and think about markets as systems, not headlines. Financial markets are not simple machines that respond to one variable at a time. They are networks of leverage, collateral, liquidity, and psychology. When pressure builds in one area, the effects can show up somewhere completely different. In calm periods, gold often trades as a clean hedge. Inflation rises, gold rises. Geopolitical risk increases, gold rises. Banking concerns surface, gold rises. But during moments of sudden stress, the rules can shift. Investors do not always sell what they want to sell. They sell what they can sell. That distinction matters. If a fund is facing margin calls, it may need immediate cash. The fastest way to raise cash is often to liquidate the most liquid assets. Gold futures are extremely liquid. Silver futures are extremely liquid. In a scramble for dollars, even safe haven assets can become sources of liquidity. In other words, a drop in gold during stress does not automatically signal confidence. It can signal funding pressure. This is where the concept of system shock comes into play. A system shock is not just a negative headline. It is a disruption in the normal relationships between assets. When correlations break down, when expected patterns fail, it suggests that the plumbing underneath the market is under strain. Today's price action may be one of those moments. Banking stress indicators are not abstract numbers. They reflect real balance sheet tension. Many banks still hold large portfolios of long-duration bonds purchased when interest rates were near zero. As rates have risen, the market value of those bonds has fallen. On paper, those losses may be unrealized. But if deposits leave and assets must be sold, those losses become real. Deposit behavior has changed in the modern era. With online banking and money market funds offering higher yields, funds can move quickly. Confidence can shift faster than it did in past cycles. That means liquidity demands can accelerate before policymakers have time to respond. Now place that dynamic next to falling gold and silver prices. If funding markets tighten, if banks or funds need dollars, they may sell metals not because they distrust them, but because they need immediate liquidity. In that case, the sell-off is not a vote against gold. It is a signal about the dollar funding environment. This creates a different interpretation of today's move. Instead of viewing it as a rejection of crisis fears, it may represent early stress in the financial system's liquidity channels. But we must be careful. Markets can send false signals. Not every sharp move reflects systemic risk. Sometimes positioning is crowded. Sometimes algorithms amplify small shifts into larger ones. The key is not to jump to conclusions, but to observe whether other pieces of the system confirm the message. Are funding rates rising? Are credit spreads widening? Are bank stocks underperforming broader indices? Are central bank facilities seeing increased usage? When multiple indicators begin to align, the probability of deeper stress increases. What makes this moment different is the timing. We are not in a zero-rate world anymore. Interest rates are elevated compared to the past decade. Debt levels, however, are much higher. Governments, corporations, and households all carry significant obligations. That combination makes the system more sensitive to liquidity disruptions. Gold and silver exist at the intersection of confidence and liquidity. They respond to inflation expectations, currency shifts, and geopolitical tensions. But they also respond to short-term funding stress. The same asset can signal different forces depending on context. That is why today's move matters. It forces us to ask a sharper question. Are we seeing a simple correction in metals? Or are we witnessing the first tremor of a liquidity event forming beneath the surface of the banking system? The answer does not lie in today's price candle alone. It lies in whether the traditional rules of market behavior are quietly beginning to break. And once market rules start breaking, history suggests we need to pay close attention to what comes next. If market rules are beginning to bend, the next step is to ask which rule is breaking first. For decades, one relationship has been deeply embedded in investor psychology. When confidence in banks declines, gold rises. This pattern showed itself clearly in 2008, as major financial institutions failed and interbank lending froze. Gold initially dipped during the most violent liquidation phase. But once central banks stepped in and the scale of the crisis became clear, gold began a sustained climb. Trust had been damaged, and investors sought a store of value outside the banking system. A similar pattern appeared during the 2011 Eurozone debt crisis. As sovereign bond yields in Southern Europe surged and fears of bank insolvency spread, gold pushed toward record highs. The issue was not just growth, it was confidence in the financial architecture itself. Then came 2020, when the global economy shut down. Markets experienced a sudden liquidity shock. In March of that year, gold fell sharply for a brief period. Investors sold what they could to raise dollars. Even U.S. Treasury markets experienced dysfunction. But once central banks flooded the system with liquidity and backstopped funding markets, gold reversed and moved significantly higher. Each of these episodes teaches the same lesson. In the earliest phase of stress, liquidation can dominate. But as the deeper implications emerge and policy responses expand, gold often reflects the erosion of confidence in fiat systems. So what is different now? The structural backdrop has shifted. Interest rates are much higher than they were in the years leading into those crises. Banks accumulated large portfolios of government bonds during the low-rate era. When rates rose rapidly, the market value of those bonds declined. On paper, these are unrealized losses. They do not immediately threaten solvency, but they reduce flexibility. If depositors withdraw funds, banks may need to sell assets. Selling long-duration bonds at depressed prices locks in losses. That reality creates fragility, even if official capital ratios appear stable. At the same time, funding markets operate on collateral. In the repo market, institutions borrow short-term cash by pledging securities as collateral. If the value of that collateral falls, or if lenders become cautious, borrowing costs rise. Haircuts increase. Liquidity tightens. Now connect this to gold and silver. When assets that are supposed to hedge risk are sold aggressively, it can signal that participants are not reallocating calmly. They are raising cash urgently. Margin calls force liquidation. Collateral shortages force sales. The need for dollars overrides strategic positioning. This is how the normal risk-off equals gold. Up rule breaks. In a pure confidence crisis, gold may rise steadily. In a funding crisis, everything liquid can be sold at once. Correlations converge. Prices move in ways that seem illogical until the liquidity layer is understood. Deposit flight dynamics add another dimension. Today, deposits can move instantly into higher-yielding money market funds or treasury bills. If even a modest percentage of depositors seek higher returns or perceive risk, banks face funding pressure. To stabilize outflows, they may increase rates paid on deposits, squeezing margins, or they may tap wholesale funding markets, which can be more volatile. Stress, in this environment, migrates quickly from headlines to balance sheets. That migration is the big signal. The drop in gold and silver, viewed in isolation, might look like weakness. But if it occurs alongside widening credit spreads, softening bank equities, and rising funding costs, it begins to look like something else. It suggests that liquidity demand is rising beneath the surface. This does not guarantee a crisis. Financial systems can absorb pressure. Policymakers have tools. Central banks can provide emergency lending facilities. They can adjust regulatory requirements. They can expand swap lines to ensure dollar availability globally. But the sequence matters. If gold is being sold because participants need dollars, it tells us that dollar liquidity is becoming more valuable relative to other assets. That shift often precedes broader policy decisions. In past cycles, once policymakers respond aggressively, gold's role shifts again. It transitions from a source of liquidity to a reflection of monetary expansion and currency dilution. So we are left with a pivotal question. Are we witnessing the early liquidation phase of a stress cycle, or simply a temporary repositioning within a stable system? To answer that, we must look beyond banks and funding markets alone. We must examine where real leverage sits in the global economy, in supply chains, in commodity flows, and in the distribution of strategic resources. Because the true balance of power may not lie in daily price charts, but in who controls the physical foundations beneath them. If liquidity stress explains short-term price swings, it still does not explain the deeper question of power. To understand that layer, we have to step away from trading screens and look at the physical world. Gold and silver do not originate in financial centers. They come from mines scattered across a small number of regions. Gold production is concentrated in countries like China, Australia, Russia, and parts of Africa. Silver often emerges as a byproduct of mining for copper, lead, and zinc, tying its supply to broader industrial cycles. Once extracted, these metals move through refining hubs, vaulting systems, and international transport networks before ever reaching exchanges. That physical chain matters more than many realize. Control over refining capacity, transport routes, and vault storage creates leverage. If geopolitical tensions disrupt one part of that chain, supply tightens. If sanctions target major producers, flows shift. These changes may not immediately appear in futures prices, but they reshape the long-term balance between paper claims and physical metal. Over the past several years, central banks have quietly increased their gold reserves. This accumulation has been especially visible outside the traditional Western bloc. Many emerging market central banks have added gold as a share of total reserves. The pattern suggests diversification away from heavy reliance on the US dollar. This is not a dramatic overnight shift. It is gradual, but it reflects a strategic calculation. Gold carries no counterparty risk. It does not depend on another nation's promise to pay. In a world of rising geopolitical fragmentation, that attribute becomes more valuable. Silver plays a different but equally important role. Unlike gold, silver is deeply embedded in industrial supply chains. It is essential in solar panels, electrical contacts, medical devices, and advanced electronics. It is also critical for certain military and aerospace technologies. As the global economy transitions toward electrification and renewable energy, silver demand rises structurally. At the same time, new large silver discoveries have been limited. Ore grades in many mines are declining. Because silver is often a byproduct, its supply depends on the economics of other metals. If base metal mining slows due to weak global growth, silver output can tighten unexpectedly. This creates a subtle imbalance. Industrial demand can remain firm even as investment demand fluctuates. That tension can lead to supply deficits that build quietly over time. Now contrast this physical reality with the structure of the paper market. Most daily price discovery for gold and silver occurs in futures exchanges. Contracts representing large volumes of metal trade hands rapidly. Many of these contracts never result in physical delivery. They are financial instruments used for hedging, speculation, or arbitrage. In calm conditions, this system functions smoothly. Futures markets provide liquidity and transparency. But during periods of stress, paper positioning can overwhelm physical flows. Large funds can push prices sharply lower through leveraged trades, even if physical demand remains steady. This disconnect can create confusion. Investors see falling prices and assume weak demand. Yet at the same time, coin dealers report strong buying. Central banks continue accumulating. Industrial users secure long-term supply contracts. Price volatility, in other words, does not always equal surplus supply. The real battle is not just between buyers and sellers on a screen. It is between financial leverage and physical constraint. It is between short-term liquidity needs and long-term strategic positioning. When funding stress forces liquidation, paper markets may dominate. But over longer horizons, control of reserves and access to logistics determine real influence. Countries that hold significant gold reserves have optionality in a currency dispute. Nations that dominate refining or manufacturing have leverage in trade negotiations. This layered system explains why daily price moves can feel disconnected from broader trends. A sharp sell-off does not erase years of reserve accumulation. A temporary rally does not solve structural supply deficits. Understanding this distinction prepares us for the next layer of analysis, because metals are not only commodities, they are also monetary assets. Their value intersects directly with currency systems, inflation pressures, and central bank policy choices. And when banking stress meets geopolitical fragmentation, the line between commodities and money begins to blur. When commodities begin to blur into money, the discussion naturally shifts toward central banks. Because once banking stress emerges, monetary policy can no longer remain neutral. Central banks operate with dual pressures. On one side, inflation may still be running above target. On the other, banks may be struggling with unrealized losses and deposit instability. Raising interest rates helps cool inflation, but it also reduces the market value of existing bonds. For banks holding large portfolios of low-yield government debt, higher rates translate into deeper mark-to-market losses. These losses are often labeled unrealized, meaning they do not immediately hit earnings if the bonds are held to maturity. But markets do not ignore them. Investors calculate capital ratios using market values. Depositors assess safety based on headlines. If rates remain elevated for long enough, time alone does not eliminate the pressure. This creates a policy dilemma. Tightening too aggressively can strain banks and credit creation. Easing too early risks, reigniting inflation expectations. The path chosen influences not only lending conditions, but also currency confidence. Historically, periods of banking stress have often led to some form of liquidity support. Central banks may open emergency lending facilities. They may expand collateral eligibility in repo operations. They may signal slower rate hikes or even cuts. Each of these actions increases the availability of base money in the system. Gold and silver tend to respond not simply to fear, but to shifts in real interest rates and liquidity conditions. When real rates decline, either because nominal rates fall or inflation expectations rise, gold becomes more attractive relative to yield-bearing assets. When liquidity expands, risk assets often stabilize, and hard assets can regain momentum. This is why the current sell-off cannot be viewed in isolation. If it reflects short-term dollar demand, the medium-term trajectory may depend on how policymakers react. Should central banks pivot toward easing to stabilize banks, the environment for precious metals could change rapidly. The global dimension deepens this dynamic. The US dollar remains the dominant reserve currency. Many global debts are denominated in dollars. When US interest rates rise and the dollar strengthens, emerging markets face tighter financial conditions. Their local currencies weaken. Servicing dollar-denominated debt becomes more expensive. Capital may flow out of weaker economies toward higher-yielding US assets. This process can create external stress that feeds back into global trade and growth. Countries with fragile fiscal positions may see bond yields spike. Sovereign debt loads, already elevated after years of stimulus and pandemic spending, become more difficult to manage at higher interest rates. In such an environment, gold serves a unique function. It is one of the few reserve assets not tied to any single nation's fiscal or monetary policy. When confidence in fiat systems erodes, whether due to inflation, debt sustainability concerns, or geopolitical conflict. Gold often regains prominence as a neutral anchor. Silver, while more industrial, can ride the same monetary currents. Its price reflects both growth expectations and currency dynamics. If global liquidity expands in response to stress, industrial demand expectations may stabilize, and monetary hedging demand can increase. What makes the current cycle complex is that inflation has not fully disappeared. Policymakers cannot ease aggressively without risking renewed price pressures, yet maintaining restrictive policy could intensify credit contraction. This tension feeds into the broader question of currency order. If repeated cycles of tightening lead to financial instability, and repeated cycles of easing lead to inflation, trust in the long-term purchasing power of fiat money can gradually weaken, not overnight, but incrementally. Central bank gold accumulation over recent years may reflect this awareness. Diversification away from single currency dependence is a strategic hedge against systemic shifts. So the drop in metals today is not just about traders repositioning. It sits at the intersection of rate policy, debt sustainability, and global currency flows. It forces us to look beyond daily volatility and consider how monetary responses shape long-term confidence. And once we connect banking stress to money creation and currency trust, the analysis becomes personal. Because changes in liquidity, rates, and currency stability do not remain confined to central bank balance sheets. They flow outward into credit availability, asset prices, wages, and everyday economic life. When monetary stress moves from policy rooms into daily life, its effects become tangible. Banking stability is not an abstract concept. It determines how easily households can borrow, how businesses finance operations, and how employers plan for expansion. Even individuals who never purchase gold or silver are directly connected to the health of the banking system. When banks feel pressure, they tighten standards. Lending officers become more cautious. Mortgage approvals slow. Credit card limits are reduced. Small businesses find it harder to roll over short-term loans. This is not dramatic at first. It happens quietly, through stricter underwriting and higher required collateral. Mortgage rates reflect more than central bank policy. They also incorporate risk premiums and funding costs. If banks perceive greater uncertainty, they may widen spreads even if policy rates remain unchanged. For households, that means higher borrowing costs or fewer financing options. Housing demand can soften, construction slows, and related industries feel the impact. Small businesses are especially sensitive. Many rely on regional banks for working capital and equipment financing. If those banks face deposit outflows or capital constraints, credit supply contracts, hiring plans are delayed, investment projects are postponed. Over time, employment growth can weaken. This chain reaction illustrates a key mental model: liquidity versus solvency. Liquidity refers to the ability to meet short-term obligations. A bank may have solid long-term assets, but still struggle if depositors withdraw funds quickly. A business may be profitable on paper, yet face cash flow stress if credit lines shrink. Liquidity problems can spread rapidly, even when underlying solvency appears intact. Solvency, by contrast, is about net worth over time. An entity is solvent if its assets exceed its liabilities. But solvency does not prevent liquidity crises. Many historical financial disruptions began as liquidity events that later exposed solvency weaknesses. Understanding this distinction helps explain why gold and silver may move sharply during stress. If investors are scrambling for liquidity, prices can fall temporarily even if long-term solvency concerns are rising. Another useful framework is short-term volatility versus long-term trends. Markets rarely move in straight lines. Short-term price swings often reflect positioning, leverage, and emotion. Long-term trends reflect structural forces such as debt levels, demographic shifts, productivity, and policy direction. A sudden drop in metals does not automatically invalidate a multi-year monetary trend, nor does a rally guarantee sustained strength. Separating time horizons prevents overreaction. A third model involves paper price versus physical demand. Futures markets determine visible prices minute by minute. Physical markets move more slowly. Central banks accumulate reserves over years. Industrial users sign supply contracts over quarters. Retail investors buy coins steadily through cycles. Paper markets can amplify volatility, while physical flows provide underlying support or pressure. Recognizing this layered structure allows viewers to interpret price action without assuming it tells the entire story. The final model is the policy reaction function. Central banks respond to economic data and financial stability risks. If inflation dominates, they tighten. If financial instability threatens credit creation, they ease or provide targeted support. Markets anticipate these responses. Gold and silver often respond not to current conditions alone, but to expected policy shifts. When we combine these frameworks, a pattern emerges. Financial stress often unfolds in stages. First comes denial, where markets dismiss early warning signs. Then liquidity stress surfaces, forcing asset sales and widening spreads. Next comes policy response, as central banks introduce facilities or adjust rates. Finally, secondary consequences appear: changes in inflation, employment, and growth trajectory. Gold and silver price movements fit within this sequence. They may fall during the liquidity scramble, then rise as policy responses expand monetary conditions. Viewing the system through these mental models replaces fear with structure. It does not predict exact outcomes. Instead, it clarifies cause and effect. And once we understand how stress travels from banks to households and from liquidity to policy, the final question becomes forward-looking. If this cycle continues to evolve, what paths might unfold next, and which signals should we watch as the story develops further? If we accept that financial stress unfolds in stages, then the logical next step is to consider what those stages might look like from here. Not as predictions, but as structured possibilities. The first scenario is stabilization. Banking stress could fade as deposits settle and funding markets normalize. Inflation could continue to cool, giving central banks room to hold rates steady without tightening further. Credit conditions might remain restrictive but manageable. In this path, gold and silver could stabilize after recent volatility, moving sideways as uncertainty declines. Under this outcome, the recent sell-off would appear as a short-term liquidity event rather than the start of a deeper disruption. Markets would interpret it as a recalibration, not a warning. Real interest rates might remain moderately positive, limiting aggressive upside in precious metals, but also preventing collapse. The system absorbs the shock, and growth slows without breaking. The second scenario is more complex. Liquidity pressures could intensify. Deposit outflows might accelerate if higher yield alternatives continue to attract funds. Regional banks could face renewed scrutiny, especially if unrealized losses remain elevated. Funding costs might rise further, tightening credit across sectors. In this environment, central banks would face mounting pressure to act. Emergency facilities could expand. Rate cuts might arrive sooner than previously expected. Liquidity injections would aim to stabilize the financial system, but they could also alter inflation expectations. If policy pivots toward easing in response to instability, gold and silver could shift direction. What appears as weakness today might transform into strength under renewed monetary expansion. The sequence would mirror past cycles: liquidation first, policy response second, asset repricing third. The third scenario extends beyond domestic banking stress. Geopolitical tensions could escalate, disrupting energy supplies or major trade routes. Commodity prices might surge again, feeding back into inflation. Governments could increase fiscal spending in response to external shocks, raising sovereign debt burdens further. In that case, central banks would face an even sharper dilemma: tightening into geopolitical disruption risks, deep recession, easing into rising inflation risks, currency depreciation. Confidence in fiat systems could erode incrementally, not through a sudden collapse, but through gradual reassessment. Gold tends to respond to that erosion of confidence. Silver, balancing industrial demand and monetary sensitivity, could move with amplified volatility. But even in this scenario, movements would not be linear. Markets would oscillate between growth fears and inflation fears, between liquidity needs and currency concerns. Across all three paths, one principle holds: Markets rarely move in straight lines. Temporary weakness does not invalidate structural trends built over years of debt expansion and monetary experimentation. Yet structural trends do not eliminate short-term reversals. Complexity defines modern financial systems. That complexity demands humility. No single indicator provides certainty. Gold's drop today may signal funding stress. It may reflect positioning. It may represent something we cannot yet see clearly. The key is to monitor whether other signs confirm or contradict the message. And this brings us to the critical cliffhanger. If today's sell-off was driven by liquidity demand, what happens if deposit outflows accelerate further? What if a mid-sized bank reports unexpected losses? Would metals experience another forced liquidation phase before stabilizing? Or would markets anticipate policy intervention sooner, shifting behavior earlier in the cycle? The next layer of the story lies in areas receiving less attention right now. Commercial real estate faces refinancing pressure as rates remain elevated. Sovereign debt markets carry heavy issuance needs amid slower growth. Parts of the shadow banking system operate with less transparency than traditional institutions. Stress often builds quietly before it becomes visible. In the next episode, we will examine where those quiet pressures are accumulating and which indicators might reveal them early. Because understanding whether today was an isolated tremor or the first signal of a broader shift requires looking beyond metals alone and into the deeper foundations of the financial system.